We are talking about the morning after the president's plan for banks to limit risk, to limit size. We're talking with Chris Whalen, co-founder of Institutional Risk Analytics. He's back with us on the telephone. Chris, you were just before the break giving us a two-part recipe for what it is that Paul Volcker and the president should be doing to fix the problems in the financial system. Briefly, recap point number one and then give us some more detail on point number two, which you were making when we had to go to break.
Well, what I was saying is this. We need greater transparency as far as pricing and flow and volume for these over-the-counter contracts. You don't necessarily have to put them on a formal exchange. You just have to open and mandate that all pricing is available to the public, to all market participants. But then I think the simple way of addressing the complexity issue, which is really, I think, at the heart of this and what Chairman Volcker is not addressing in his proposal, is just make sure that all of these securitizations, all of these structured assets are registered with the SEC. And then the lawyers will prevent the firms from going beyond a certain degree of complexity because, by definition, when you register something with the SEC, it's available to retail.
Chris, how likely on a scale of 1 to 10 is any part of this Volcker Rule, any part of what was discussed yesterday, actually be put into practice?
Well, I think very low, maybe two. It's a very low probability. I don't think the industry would accept it, and now that the Republicans have 41 votes in the Senate, I think they could block it. And frankly, there are Democrats who would cross the aisle and block this proposal too.
Chris, assuming something does happen, notwithstanding the fact that you think it won't, I want you to wade into the debate on Goldman Sachs. There's been a lot of ink spilled over the past 24 hours on what this means for Goldman. What do you think it means for Goldman? Well,
honestly, if you listen to the Goldman call, which I encourage people to do, David Viniar, the CFO, was very forthright. He said, look, about maybe 10% more or less of our flow, our volume, is proprietary, and the rest is customer. So by definition, they could get out of the proprietary business if they had to. And all that would mean is that they would gain a customer because they would roll that business into a fund, and the next day it would be another hedge fund dealing with Goldman and the other firms. So I don't think it would be a big deal. Customer business is really what drives most of Goldman Sachs' revenues. And if you know the firm and you understand it, they would not like to lose a proprietary piece. Of course not. That's an important part of their culture. But I think as a practical matter, it's all missing the point, because if you look at Glass-Steagall, what we were really focused on in the 30s was underwriting and sale of securities. It had nothing to do with proprietary trading. So I kind of scratch my head when I look at this proposal from Chairman Volcker, because I don't know where this came from, to be honest with you.
All right, Chris, we have about, 30 seconds left. JPMorgan Chase is another name that has come up. Do you see any potential effects there?
Well, again, they don't want to lose the proprietary piece of the business. Of course not. They make money on it. But I think, honestly, the more likely scenario is that something like the current reform legislation gets passed. We may have some kind of discussion about size limitation and market share. Okay. But I don't think this proprietary trading proposal is ever going to see the light of day.
Chris, we thank you, as always, for your insight.
Thank you.
Chris Whalen, Institutional Risk Analytics.